The Labour budget marks the biggest tax raid in history, and the government will collect £40 billion in taxes. UK tax revenue will reach its highest level as a share of GDP by the end of Parliament. If you're new here, I'm a qualified accountant and experienced tax advisor, and in this video I'll tell you 7 of the main tax changes that will impact you. It is true that Labour have targeted the wealthiest people with this budget. They have abolished the non-dom tax regime, they are introducing VAT on school fees, and they're increasing air passenger duty on private jets. But working people will also have less money in their pockets as a result of some of the tax changes. Plus, they're taxing us way more than they initially promised.
We don't need higher taxes. What we need is growth.
So the first major change is to national insurance. So the biggest tax increase was aimed at employers, with national insurance contributions increasing. And that's expected to raise 25 billion out of the total 40 billion that this budget is aiming to raise. So what's basically happening is the national insurance rate, which employers pay, is increasing by 1.2% from 13.8 to 15%, and the threshold at which it has to start being paid is also reducing. Initially, you probably would assume that that would only impact businesses, but it will actually impact employees and consumers as well, because businesses can't absorb all of those increased tax costs and still run as profitable businesses. So they will have to pass on the costs to other people in order to continue to function. The Office for Budget Responsibility have said, we assume that firms pass on most but not all of their higher tax costs to employees. In 25 to 26, the year it's introduced, we assume firms pass on 60% of the higher costs to workers and consumers via lower wages and higher prices. And then they've also gone on to say that they assume that more of those costs will be passed on to employees in later years. So whilst employees haven't been taxed more directly, and Labour have kept their promise that way, employees and consumers will feel the impact of businesses being taxed more, because they will experience less pay rises, there'll likely be less promotions, and firms will just stop employing as many people. The OBR have predicted that firms will reduce their demand for labour as a direct result of the increase in national insurance, because essentially it will cost each firm more money per employee. The second change is to income tax. So nothing has really changed when it comes to income tax, but that's exactly why this is known as a stealth tax, because what Labour have done is they have frozen the income tax thresholds as they currently are until April 2028. And that means that more people will be dragged into paying tax for the first time, and more people will start paying tax at higher rates as well. So as we approach the 28-29 tax year, the OBR have predicted that 4 million people will start paying tax for the very first time. 3 million people will start paying tax at the higher rate, which is 40%, and 400,000 people will start paying tax at the additional rate, which is 45%. And that's all because wages will be increasing, but the income tax thresholds will stay the same. So that means that more of individual salaries are being pulled into those higher tax bands. So we could say that the promise of not taxing working people when it comes to income tax isn't technically going to start until April 2028, because that's when those income tax thresholds will start to move in line with inflation. The third change that could impact you is to capital gains tax. This tax is levied on the profits that you make from the sale of your investment. The change is to the capital gains tax main rates. So for basic rate taxpayers, the main rate has changed from 10% to 18%, and for higher and additional rate taxpayers, the main rate has gone up from 18% to 24%, and that brings the capital gains tax main rates on those other assets in line with the capital gains tax rates for residential property. The tax increases could have been much higher because there were lots of people who were expecting the capital gains tax rates to be more in line with income tax rates after the budget. So that would be more like 40% and 45%. So the increases aren't as high as they could have been, but they could still deter people from investing in UK companies and other UK assets. As Rachel Reeves pointed out, the UK does still have the lowest capital gains tax rates out of any other European G7 country, and UK landlords will be relieved to know that the capital gains tax rates for them haven't changed. So when they come on to sell their properties, they will still pay the same capital gains tax as they did before this budget. The fourth change is to inheritance tax. Only 4% of estates actually pay inheritance tax, but Labour have frozen the threshold after which inheritance tax has to start being paid until 2030. And that means that more estates will be dragged in to paying inheritance tax because the value of those estates will increase over time. And that's known as fiscal drag, and it's the same concept that we spoke about when we talked about income tax bands being frozen. So the nil rate band has been frozen at £325,000, which means that you can pass on that much before your estate has to pay inheritance tax. And the residence nil rate band has also been frozen at £175,000 if you're leaving your home to your children or your grandchildren. One of the biggest changes is to farmers, which you may have heard about, because one of the inheritance tax reliefs that was generous for farmers was known as agricultural property relief, and it meant that farmers could pass on the assets in their farm to the next generation free of inheritance tax if they qualified. Labour have capped that relief, which means that not all farms will be able to pass on farming assets to the next generation free of tax. The National Farmers Union has criticised that by saying that the budget has been disastrous for farms and it will impact the ability for the next generation to continue British farming. But the government has said that they don't think the change will impact too many farms. The next change is to pensions. In the past, pensions have not been considered to be part of somebody's estate for inheritance tax, which means that they're not taken into account when calculating if somebody's estate exceeds the £325,000 nil rate band. But that's changing from 2027 because Labour have said that pensions will be subject to inheritance tax. Most estates still won't have to pay inheritance tax on pensions because most people's estates still won't exceed the nil rate band, and it's only predicted that 8% of estates will actually have to pay inheritance tax on pensions. So really it's only the wealthiest pensioners' pension pots that will be subject to the new tax. The next change is to private school fees. VAT will be introduced on private school fees from January 2025, but this isn't a surprise because Labour have said that they would do this all along. It's not yet known the impact that that will have on private schools and state schools, but the IFA magazine have said that 15% of private school parents are likely to take their children out of private schools because of the increased costs. So we could see up to 90,000 pupils joining state schools. The next change is to non-doms. The concept of non-dom status will be abolished and domicile will no longer be a relevant concept when considering inheritance tax. Inheritance tax used to be based on domicile, which is where you consider your true home to be and was usually the place that you intended to die. But that will now be replaced with a residence test, which says that if you have lived in the UK for at least 10 years out of the last 20 years, then you'll be subject to UK inheritance tax on your worldwide assets. You remain within the scope of UK inheritance tax for up to 10 years after leaving the UK. So you can't suddenly leave the UK and then expect inheritance tax not to apply. It's based on how long you've lived in the UK in the past, and that's known as your inheritance tax tail. If you're already living away and you've lived away for at least 10 years out of the last 20 years, then you shouldn't be subject to UK inheritance tax on your worldwide assets. But if you have UK assets, then UK inheritance tax will always be chargeable on those assets, regardless of your residence. So that was a quick summary of the main tax changes that could impact you as a result of the budget. Let me know in the comments if there's anything else that you want me to cover in more detail. Subscribe to the channel if you haven't already, because it really will help it to grow, and I will see you next time.